What have you done in your Janus Unconstrained Fund as we've moved rapidly from 240 to 250 and soon a print of 2.60%?
Well, good morning, Tom. We've gone short bonds, not just treasuries, but short gilts and short bunds, left the JGB market alone. But, it appears that it's a treasury phenomena and treasury directed based upon your Bloomberg report this morning with China being disaffected with U.S. treasuries, and your report a day or two ago about JGBs and their change in quantitative easing policies. But nonetheless, it appears a negative type of posture for bonds. I've also gone rather negative on high yield bonds and credit spreads because, as yields rise, zombie-like corporations pay higher yields and their spreads are compressed and their cover is compressed. And so this is not a favorable element for high yield bonds or sovereign bonds. And it's not a favorable element this morning, at least for the dollar.
You worked for years and you built for years a small shop that had enough mass where the Chinese worried about the Pacific Investment Management Company. Give us your experience of what China's doing at the margin with their treasury obligations.
Well, they certainly haven't been building treasuries, and recent evidence over the last few months suggests that they've been liquidating treasuries, supposedly in an effort to more diversify their portfolio, perhaps. In any case, the liquidation of treasuries as opposed to the accumulation of treasuries by China over the past few years is certainly a negative. And, one of the things mentioned several days ago by your reporters has to do with quantitative easing, to the extent that the Japanese are less easy in terms of their purchases of JGBs, to the extent that the ECB at some point later this year pulls back. We've got a worldwide situation in which central banks in total, add in the Fed that's actually reducing their portfolio, in which the world central banks in total are not adding to their portfolio like they have in the past. There's been $14 trillion worth of bonds bought by central banks in the past 4 to 5 years. That appears to be close to an end.
Bill Gross, given your negative view on high yield and sovereign debt and so on, so where should investors go for yield right now?
Well, that's a good question because, a dramatic rise in yields, and I'm not suggesting that. I've suggested that once we broke the 240, 45 barrier on the 10-year, and it appears that we have, which is a long-term trend line over 25 years, that, the increase is likely to be mild. I think 10-year treasuries, could approach 2.7, 2.8% by the end of 2018. And what does that mean? That means another 2 or 3 points loss, and it basically wipes out all income for the year. It's not a bear market per se, but it's certainly not a bull market. To be technical, bear markets bottomed in 2012 and June of 2016 at 145, and so we're 100 basis points plus higher. That could be defined as a bear market, but I think more legitimately because bonds, for those years did still 3 or 4% based upon, high yield total returns. That the bear market that I'm talking about is a mild one, but it includes, negative prices for high yield bonds.